Well, hey, gang, Steven Sitkowski here. Welcome to this week's Market Insights. Hope you're having a good week. I took my 16-week-old puppy to puppy camp today. So he goes for 5 days, gets trained to be a big dog, and all I can say is I hope he's doing better than me. It was, it was tough to hand him over to somebody else. He's kind of nervous and pressing into me, but yeah, it's part of the deal. Want to get your dog trained up. Anyway, hope you're doing well. Had a good weekend. Nice comeback today in the markets. Quick reminder that everything that we do here is for educational and informational purposes only, not intended as investment advice. So what's moving the markets? The stocks bounce after Friday's sell-off. So we sort of recovered everything that we lost on Friday. So that was nice. I don't see any real major catalyst happening today that would make that logical. Maybe the market sold off Friday and then recognized there was no real reason for the sell-off. It's the best I can come up with. Jobs data has been a bit concerning, those of you that follow such things. So, first of all, new job creation reported last week was below estimates, but then there was a revision for the last couple of months that wiped out like 268,000 jobs, and the president of the United States got pissed off and fired the person that provides the numbers. He thought that those numbers were politically motivated, so he's going to hire somebody else, I suspect, who will put in the numbers that he finds more agreeable. I don't know, it's kind of interesting. That would sort of be like, you go to school, teacher gives you a bad report card, you fire her or him, and then you replace it with somebody who's going to give you a better grade. Kind of an interesting dynamic. The EU will delay its US tariffs by 6 months. That's kind of a right out of Trump's playbook. And I get it, it's all part of the negotiations. It's not a criticism on anybody, but it's just interesting to watch that, countries, including us, set deadlines on tariffs, but then we back off of them. So EU says, hey, listen, as long as you're talking to us, which is kind of what Trump says, right, to these other countries, as long as you're talking to us, we'll delay the tariffs. They delayed by 6 months. I mean, that's a long delay. 10-year Treasury is down a whole bunch. So, the future of interest rates has changed a lot based on that weak jobs data. I think there's a very good probability now that we'll get a rate cut in September. That wasn't the case prior. And oil prices pretty steady. OPEC, I guess, is raising prices, but is not reflected, at least not yet, in the spot market. So what to watch this week? Not a super busy week. Factory orders came in a little lower, but better than expected. We're expecting a drop of 4.9%, came in at 4.8. Tomorrow, I mean, will the services PMI or ISM, is that going to move the market? Not likely. Fed speak on Wednesday, is that going to move the market? No. So what is going to move the market? Earnings, if anything. Thursday, initial jobless claims, as we get every Thursday morning, supposed to tick up to 221,000. Nothing else going to move the market, and no announcement scheduled for Friday. So all in all, pretty quiet. Last week's heat map, not very pretty. Microsoft and Meta had great earnings announcements, hence they were up. Amazon, not so much. Down on the week, 8%, Tesla down 5%, Target down 6%. I don't know what it's like going to a Target around you. I just find them to be such a poorly run operation. Um, I rarely go in there. They're next to a grocery store that I use. So if they have something the grocery store doesn't, I may run over there. And every time I go in there, it's just a lousy feeling. I don't, could just be me. I'd prefer to walk into a Walmart, to be honest with you. And I'm not in there very often either, but that'd be my preference. Utilities did well, kind of a flight to safety. Jobs revisions, that's what I was talking about. Look over here. I mean, you talk about crash and burn. So there's negative 300,000. We were in that neighborhood. Not good. Stocks trading above their 50-day moving average. You can see the trend. It's been going down. We're now down below 50%, sitting right at about 50%. We like that number to be above, that level, um, to call the market bullish. Ironically, market sentiment went up a little bit. Percentage people think market's going up over the next 6 months, moved up from 40 previously at 36.8. Historically, we're at 37.5. And the bearishness went from 34 to 33, no appreciable difference there to speak of. This week's earnings announcements today, Palantir after the close. Tomorrow, Caterpillar, Industrials have done really well. Marriott will give us some idea of travel. AMD after the close on Tuesday. Wednesday, we have Disney, McDonald's, Uber after the bell. Thursday, Lilly. Anything else on there that looks, yeah. Friday, nothing significant. So we've kind of slowed down the earnings parade. Let's take a look at the charts. SPX, which is a proxy for the S&P 500, you could see it was kind of flirting with, 50-day moving average. But it has made a comeback today. But boy, there was definitely some rolling over. Let's take a look at a couple of the other indicators. So the MACD went slightly bearish. The relative strength index, so this was in overbought territory. I'll tell you, a combination to watch, those of you who like technical analysis. When the MACD turns red and we're in overbought territory, that is one of the best predictors of something falling that I have seen. Those two in combination. So now we're hoping that this is the beginning of kind of a move higher. We're still well above the 50-day moving average, and the 50-day moving average itself is sloping upward. How about the Qs? Yeah, almost looks identical. Actually, the Qs might look slightly better than the S&P 500. So kind of a ho-hum week. Glad to see we're off the mat, to get started for this week. Let's hope it's a sign of things to come. Otherwise, I'll be back with you next week. Till then, be safe, be blessed. Bye for now.